Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Good to be here.
So, we have to talk about January. Usually, the first month of the year is when the market just kind of settles in.
Likes to sleep out of its eyes.
Exactly. People are logging back into their accounts, maybe tweaking a few things. But January 2026, it felt less like a gentle nudge and, I don't know, more like a bucket of ice water to the face.
An incredibly aggressive start to the year. I mean, we're seeing shifts in money and in policy that would normally take, a decade to play out. And it's all happened in about 4 weeks.
Right, and that's why we're here. We're not just doing a recap. We really need to unpack 3 specific huge shifts that have just happened.
Things that have a real impact.
A huge impact. We're talking about a record-breaking rotation of cash, a brand new government stockpile. It sounds like it's straight out of a movie, and a massive geopolitical trade deal that really changes the energy map.
And, the common thread through all of it is risk. It seems like everyone, from the smallest investor all the way up to the president, is just scrambling to hedge their bets.
Okay, so let's dive into that first big story. What some are calling the Great Rotation. I was looking at the fund flow data, and the headline number is just staggering. $165 billion flowed into U.S. ETFs in January.
Right.
Now, on the surface, that sounds like a massive vote of confidence in the U.S. economy. But you're telling me that number is, it's a bit of head fake.
It's a bit of a mirage, yeah. If you just look at that top number, it looks like everyone is buying America. But when you start to peel back the layers, when you take out the passive money, the cash that automatically goes into 401ks every month.
The automatic stuff.
Exactly. The active money, the so-called smart money, is doing something completely different. Reuters actually has a name for it, the Sell America trade.
Selling America sounds pretty dramatic. Are we talking about investors betting on a crash?
No, and that's a really important distinction. It's not a bet against the U.S. economy collapsing. It's a bet against concentration.
Okay, what do you mean by that?
Think of it like a home renovation. For the last, say, 5 years, you've put every single spare dollar into making your kitchen perfect. It's amazing. It's worth a fortune. But then you look around and you realize the roof is leaking and the basement's flooding because you've ignored the rest of the house. Investors are looking at their portfolios and seeing they're maybe 80% U.S. tech stocks.
All in the kitchen.
All in the kitchen. And with the political uncertainty we're seeing right now, with tariffs and Fed policy, that's just a dangerous lack of balance.
So they're not selling because they hate the kitchen. They're selling because they need to go fix the roof.
That's it. Precisely. They're taking some profits from those high-flying U.S. stocks and putting that money somewhere they can get more bang for their buck.
And that somewhere is emerging markets.
Right now, it's flooding into emerging markets, or EM. We saw over $14 billion go into EM funds in January alone. That's a monthly record.
Okay, but let's push back on that for a second. Emerging markets is such a broad term. I mean, usually that means a basket of everything from Brazilian oil companies to Chinese banks. Is that what's happening? Are people just spraying money all over the globe?
No, and this is where it gets really interesting. It's not a shotgun approach at all. It's more like a sniper. Investors are skipping the broad general funds and going straight for very specific markets.
Which are?
South Korea and Taiwan.
Okay, that makes sense. I see where this is going. This is a tech play.
It's the AI supply chain play. Look, stocks like NVIDIA and Microsoft in the U.S. are, they're expensive. They're trading at huge premiums. But if you look at South Korea, you find the companies that are actually making the physical hardware, the memory chips, that make AI possible. You look at Taiwan, and you have the fabs, the manufacturing. And those markets are trading at a big discount to the U.S.
So it's a leverage play. You still get exposure to the whole AI boom, but you don't have to pay that, let's call it the Silicon Valley tax on the stock price.
You got it. And there's a currency angle here we can't ignore either. For years, the U.S. dollar has been incredibly strong, a wrecking ball.
Right.
But the general view now is that the dollar has probably peaked. And if the dollar gets even a little bit weaker, all those foreign stocks automatically become worth more in dollar terms. It's a potential double win.
But there is a risk, isn't there? I mean, Taiwan isn't exactly a geopolitical safe zone. It's the absolute focal point of tension between the U.S. and China. Isn't pouring money into Taiwan right now incredibly risky?
It is. Of course it is. But that's the irony, right? Investors are weighing the political risk of U.S. policy under the Trump administration, sudden tariffs, new regulations, against the geopolitical risk over in Asia. And right now, believe it or not, they see the Asian tech supply chain as the better bet. They're betting the world simply cannot function without those chips, no matter what the politics are.
That is a very bold bet. Okay, speaking of things the world can't function without, let's pivot. We've talked about financial capital moving around. Now let's talk about physical capital, critical minerals.
This brings us to Project Vault.
The name alone sounds like a summer blockbuster, but this is very real. It's a $12 billion initiative the administration just launched on February 2nd.
It is. And it's meant to address a huge vulnerability in our national security. For decades, our supply chains have been all about efficiency, just-in-time delivery.
Right, get the part right before it goes on the car.
Exactly. But in a world full of trade wars and tension, just-in-time is actually dangerous. Project Vault is the big shift to just-in-case.
So break down how it works. I've seen it described as a government stockpile, but it's not just the government buying a bunch of rocks and hiding them in a cave, is it?
No, and that's what's so clever about it. It's a public-private partnership. About $10 billion is coming from the Export-Import Bank as loans, but $2 billion is from private investors. And the model is basically a retainer system.
A retainer, like you pay a lawyer just in case you get into trouble.
Very similar. Think of it more like a subscription service for disaster insurance. A big defense contractor or an EV maker pays a membership fee to Project Vault.
Okay.
In exchange for that fee, the project keeps a rolling 60-day stockpile of critical materials for them. We're talking antimony for ammunition, gallium for radar systems, lithium for batteries.
So if China suddenly decides to ban exports of, say, gallium, which they have threatened to do, a company like Lockheed Martin doesn't have to shut down its assembly line.
Correct. They just call up Project Vault and draw down on their 60-day supply. It prevents panic buying. In commodity markets, fear can drive prices up way faster than an actual shortage.
It's a buffer.
It's a buffer. It stabilizes the whole market because everyone knows it's there.
But I have to play devil's advocate for a second. $12 billion is a lot of money. Why is the government basically subsidizing inventory for these massive private companies? I mean, if Ford or Boeing need lithium, shouldn't they just buy it and store it themselves?
That's a really valid critique. And the counter-argument is that individual companies, left to their own devices, will always prioritize their quarterly profits over long-term security. Storing 60 days of anything is expensive. It just sits on your balance sheet. You have to insure it. Companies will always try to run lean to keep shareholders happy. The government is basically stepping in and saying, look, national security is more important than your quarterly efficiency numbers.
So it's kind of like forced resilience. But here's the part that I'm still stuck on. We can stockpile all the raw ore we want, but digging the stuff out of the ground, that isn't really the hard part, is it?
You've hit the nail right on the head. And this is the giant asterisk next to Project Vault. The real bottleneck isn't mining. It's refining. It's the processing.
Turning the rock into the actual metal you can use.
Exactly. You can have a mountain of lithium ore sitting in a warehouse in Nevada, but if you can't turn it into battery-grade carbonate, it's just a pile of dirt. And right now, China controls somewhere between 60 and 90% of the refining capacity for most of these minerals.
So Project Vault, it just buys us time. It doesn't actually solve the core problem.
It buys us 60 days. That's it. Unless we start building our own refineries here at home, which are dirty, expensive, and take forever to get permits for, we are just stockpiling raw ingredients for a kitchen we don't have.
A necessary first step, maybe?
A necessary first step, but investors shouldn't look at this and think, okay, problem solved. It's more like a Band-Aid on a bullet wound.
A $12 billion Band-Aid. Okay, let's move to the final piece of this puzzle. We've done money, we've done minerals. Now let's talk about the flow of oil. There is a huge new deal on the table between the U.S. and India.
This is classic transactional diplomacy. The oil for tariffs deal.
Okay, let's lay out the terms. The U.S. agrees to cap tariffs on Indian imports at 18%. Now, for context, with the current administration's stance, there were fears those tariffs could go as high as 50%.
Oh, yeah.
So getting it capped at 18% is a huge win for Prime Minister Modi.
It basically saves their entire export sector.
Yeah.
We're talking about Indian textiles, pharmaceuticals, jewelry. They all rely on the American consumer.
Yeah.
A 50% tariff would have just been devastating. 18%. They can work with that.
And in exchange for this, the quid pro quo is...
India has to stop buying Russian oil.
Which is massive. I mean, since the war in Ukraine started, India has basically been the #1 customer, keeping the Russian economy afloat, buying all their crude at a big discount.
They have. So if India really stops, Russia loses its biggest and most important customer overnight.
It's a geopolitical masterstroke. if it works. It would pull India firmly into the U.S. camp, strengthens that whole Indo-Pacific strategy, and it chokes off a major revenue stream to Moscow.
It forces India to finally choose a side.
But is it actually enforceable? This feels like one of those deals that sounds great in a press conference, but then just falls apart in the real world. I mean, oil is fungible. Once it's on a tanker in the middle of the ocean, it's just oil. How do we even know India isn't just buying Russian crude, mixing it with something else, and then saying, oh, this is from somewhere else?
You're pointing to the shadow sleep problem.
Yeah.
And you're absolutely right to be skeptical. The global oil market is incredibly opaque. You have tankers that literally turn off their tracking devices. They do ship-to-ship transfers in the middle of the night.
Oh.
Verifying that India has actually stopped buying Russian oil is going to be a complete nightmare for regulators.
And there's an economic reality for India too, right? Russian oil is cheap. That's why they were buying it. If they have to switch to American crude or Saudi crude, they're paying the full market price. That means energy costs in India are going to go up.
It does. It means inflation.
Does Modi really want to risk that just to make Washington happy?
Well, he might not have a choice if the alternative is losing access to the entire U.S. consumer market. But you raise a great point about substitution. If India stops buying from Russia, they have to buy from somewhere.
Could that somewhere be the U.S.?
Well, that's almost certainly the secondary play here. U.S. oil production is at record highs. We have plenty to sell. This deal could essentially be a way to force India to swap out a Russian supplier for an American one. It's a huge potential win for producers in Texas.
So we use the threat of tariffs as a stick to force them to buy our carrots.
That is the Trump doctrine in a nutshell, using economics as a tool or even a weapon of national security.
So let's zoom out for a second because we've covered three pretty different topics. Moving money to Korea, stockpiling minerals here, forcing India to change oil suppliers. It really feels like the whole era of free trade, just buy the best product at the cheapest price well, it's over.
It's on life support, for sure. We're moving from an era of globalization to one of fragmentation. It used to be that the only thing investors cared about was efficiency. Where can I get this made for the least amount of money?
Right.
Now, the number one metric is security. Is my money safe? Is my supply chain safe from a blockade? Is my energy source safe from sanctions?
And all that security comes with a price tag. It costs more to stockpile things. It costs more to buy oil from a more expensive but friendly country. It even costs more to diversify your portfolio.
Exactly. We are entering a more expensive, higher friction world. And that means inflationary pressures might be a lot stickier than people think because security is just inherently inefficient.
So, for you listening and trying to figure out what to do with all this, what's the move? If the world is breaking apart into these blocks, do you just sit in cash?
No, I don't think so. Cash has its own risks, especially with inflation. The move is to try and align your portfolio with this new reality. If the U.S. government is serious about reindustrializing and stockpiling, then maybe you look at the companies building the new warehouses or the new refineries.
Follow the money.
Follow the money. If supply chains are moving to so-called friendly nations like Korea or India, look at the infrastructure plays in those countries. The point is, don't fight the fragmentation. Try to invest in the companies that are going to win because of it.
So you follow the friction. That's a really interesting way to look at it.
And you watch the execution. Like we said, with both the India deal and Project Vault announcements are easy. The logistics are the hard part. So watch the actual shipping data. Watch the refinery output. That's where you'll find the truth.
It feels like 2026 is going to be the year of show me. Don't just tell me you have a stockpile. Show me the refined metal. Don't just tell me you stopped buying Russian oil. Show me the tanker logs.
Trust, but verify. And then probably verify again.
Before we wrap up, I do want to leave our listeners with one final thought. We're seeing the U.S. build all these buffers, secure new alliances, move assets around the global chessboard very, very aggressively. It feels like preparation.
It does.
And the question is, are we preparing for a boom in a new, more secure global economy? Or are we just battening down the hatches because the government knows a storm is coming that the rest of us can't quite see yet?
And that is the multi-trillion-dollar question, isn't it? Are these proactive growth strategies, or are they defensive fortifications? The line between those two is very, very thin.
Something to think about. That is all the time we have for today. We hope this deep dive helped you connect some of the dots between the headlines and your own wallet.
Thanks for having me.
Don't forget to subscribe and hit that like button. We'll catch you next time on Investment Insight.